In the last video of this topic, we will discuss the rest of accounting terms. First one is liability. Liabilities are the obligations or debts payable by the business in future in the form of money or goods. For example, Mr. A has purchased goods on credit from Mr. Z worth $10,000. In this case, Mr. A has a liability of $10,000. Financial statements. Statements prepared by an enterprise at the end of accounting year to assess the status of income and assets is termed as financial statement. It basically includes two statements, income statement and position statement. Next term is goods. Goods are the commodities in which a business deals. Next term is stock. Stock means the goods which are available with the business on a particular date. Stock can be of raw material which will be used for manufacturing, work in progress which is on the machines for manufacturing, and finished goods which is ready to be sold. Moving on to the next term, that is debtors. The person from whom the amount is due for goods sold or services rendered or in any aspect of contractual obligation is called debtor. For example, Mr. A has purchased goods worth $10,000 from Mr. Z. In this case, the amount is due from Mr. A by Mr. Z. Mr. A is debtor in this case. The total amount due from debtors is called book debt. These are shown under the current asset head in balance sheet. Next term is creditors. The person to whom amount is owed by the business on account of goods purchased or services rendered or in respect of contractual obligation is known as creditor. In the previous example, the amount is due to Mr. Z by Mr. A, so Mr. Z is a creditor. The creditors are collectively known as trade creditors. These are shown under the current liability head in the balance sheet. Next term is expenditure. Expenditure is the amount spent on liability incurred for the value received, like goods, assets purchased, or services availed. It may be classified into three categories, that is, capital expenditure, revenue expenditure, deferred revenue expenditure. Now, the payment made for the purchase of fixed assets or payment of long-term liability is known as capital expenditure. The benefits of such expenditure are derived in future. It is non-recurring in nature and increases the earning capacity of a business. For example, purchase of land and building, payment of long-term loans, etc. And the next term is revenue expenditure. The amount incurred for the purchase of goods or services which are consumed during the current period is called revenue expenditure. The benefits of such expenditure are normally utilized in current period. This expenditure is recurring in nature. The common examples are salaries paid, insurance paid, purchase of goods, etc. And the last term of this topic is deferred revenue expenditure. Deferred revenue expenditure is an expenditure which is revenue in nature and incurred during an accounting period. Its benefits are to be derived over a number of following accounting periods. The common examples are advertisement suspense account, discount on issue of shares and debentures, preliminary expenses. These expenses are shown on the asset side of the balance sheet.